Equity markets around the globe have added about 10% over the past few weeks, but following a fall in equities in May and June, markets are only marginally higher than they were at the end of last year. So for those fully invested in equities, returns look pretty miserable at this stage. Joining me with more is Mike Estment. He's the CEO of NFB Financial Services Group. Mike, thanks very much for coming in today. Like I said, equity investors have barely beaten inflation this year. Should they have changed the mandate of their managers?
Yeah, the point that one has to deal with there is that the man in the street is not always aware that if you invested through a unit trust or one of the other portfolios offered through the retail distribution propositions out there, is that an equity manager's mandate is to be fully deployed into equities. His job's not to be in cash, his job's not to be in property or in bonds. It's to be in the South African or any other exchange. With that comes the volatility, the risk, normally and historically dividends, but in the latter last few years, that hasn't always been the case. So the risk there is quite significant. So understanding that and interacting with one's advisor or just understanding what's on the can is pretty important.
So when you say fully invested in equities, are we talking 100% here or just a very high portion of equities?
A very high portion. Typically, Stephen, the managers will keep the minimum amount out of the market. They are competing against their peers. Their peers are going to be as fully invested as possible. You have to have a buffer for, I guess, the administrative and management fees as well as withdrawals. You don't want to have to fund withdrawals by having to sell equities at an inappropriate time, but they would be between 90 and 95% deployed all the time.
And of course, you read in the press that global fund managers, particularly in the United States, are sitting with up to 40% cash at this stage. So being quite cautious about the outlook for equities. So it is a volatile period. What should retail investors be doing during a period like this?
Well, I think where you look at pension managers and big fund managers, what they're doing is they have a mandate to apply funds. They will get from certain and more prevalent more recently as the responsibility for the outcome on your pension fund is moved from the corporate to the individual. Defined contribution funds, as they call them, as opposed to the old defined benefit, where you got a percentage or a share of your retirement salary, is that you can, in certain instances, make a decision about whether you want to be cautious, balanced, or an aggressive investor. And there are some guidelines that the governments around the world typically instill to obviate massive losses in pension funds. But the investor has to understand that they either have the mandate to choose low, medium or high risk investment, or that the managers responsible for that will act accordingly. In a unit trust, that's not the case. In an equity unit trust, you have also an array of different risk profiled funds that have proliferated in the last decade or two, where you can get a managed or a cautious fund who have the ability to change the amount of equities, the amount of bonds, or the amount of property or cash in the funds. That probably for the less professional investor out there would be a better choice, is a balanced mandate.
And of course, you talk about admin and management fees and things, and they really eat into your investments as well, don't they? So if you'd only gained 3% as an equity unit trust investor this year, you could have actually lost that 3% through costs.
Yes, that's absolutely true. I think that there's a huge debate that wages, and you'll see it in the media, and it's a very emotional discussion. And quite often you'll hear that there are not too many active managers who outclass the index, therefore there's a strong business case for passive investment. But in South Africa, there are 5 or 6 of the top houses that absolutely regularly, in the short, medium and long term, have pummeled the indices. But again, have you chosen the correct jockey as their jockey moving shop? Will that impact, or is it the shop that's delivering the result rather than the man whose name's up there as portfolio manager? All of those things are pretty critical to get right. The question that you ask, though, is can the costs of managing money diminish or in fact completely erode and zero your returns? Yes, absolutely they can.